the 3.8% tax. Are you impacted? If you haven't subscribed to this channel, please do so below. So in this video, I'm going to cover the net investment income tax. It's the 3.8% tax that are applied to certain individuals. And we're seeing a lot of our clients get impacted by this. It seems like every year more and more households are getting impacted. I'm going to just walk through the history of this tax, and I'm going to describe a couple tax planning tips, not all of them, just a couple to consider. At the very end, I'm going to show you a tax return and to show you how it's being calculated and things that kind of consider to kind of help reduce your tax liability. And for some of you, it might just be a couple $100 worth of tax. For others, it might be a couple $1,000s worth of tax. But there's ways on how to kind of reduce it, and you should just be very mindful of this. It's been around since 2013. So again, thank you for watching this video. If you haven't subscribed, please do so below. Thank you.
All right, so I'm just going to go through two slides here on the net investment income tax. As I noted earlier, it's a 3.8% surtax, and essentially it's on income, including interest, including CDs, dividend, rental income that isn't professionally managed, and capital gains, as well as some other items. It was started in 2013 as part of the Affordable Care Act, and it was essentially used to fund the Obamacare health coverage. So this tax is also known as the Obamacare tax. And it was all around this Obamacare health coverage. Who does it apply to? So if your adjusted gross income is greater than $200,000 and you're filing single, or if your AGI is greater than $250,000 and you're filing a married file joint return. So those are the kind of the individuals that are impacted. And again, the key number here is adjusted gross income. And I'm going to show you this in a tax return example here. So some of the facts here and why this is kind of coming up in the news a lot is because more and more households are being impacted, right? So this started in 2013, 3 million households were impacted. 2021, 7 million households were impacted. So it's almost doubled in about 7 years here. And in the government, what they've raised through this in revenue, tax revenue, 16 billion in 2013 and 60 billion in 2021. So it's continuing to increase. Now, what's not part of this calculation is wages, pensions, Social Security, income from S corps and partnerships. However, this could trigger whether some of these other items that we talked about earlier, like interest income, dividend income, capital gains, when you sell stock, could come into effect, right? So, if you just have W-2 income and it's greater than these amounts, you might be okay. But if your income is greater than those amounts, and then on top of that, you got some interest and dividend income, then you're going to be subject to this net investment income tax. Now, some tax planning tips. There's a couple out there. I'm just going to list a few right here. But again, the key here is your AGI, right? You're trying to reduce this AGI. So, tax deductible contributions to traditional IRAs, contributing to your 401k plan. You're contributing to an HSA, health savings account. I mention this a lot to people, our clients out there, prospects and stuff. This is key, right? Especially as you get older, it's easy to kind of put this money away now. And as you get older, you're going to have a lot of health, issues, and having, an account all built up and being able to take this money out tax-free is key. You may want to, consider converting traditional IRA assets into Roth IRA. And you remember, tax-free payouts don't increase your AGI, right? So once you're in a Roth IRA and you decide to kind of take that out in retirement, those distributions are tax-free and that won't impact your AGI. And then consider, harvesting losses, right? So just say you sold a bunch of Apple stock this year, you got these large capital gains, but then you might also own some other stock that are losers, right? And they're in a loss position, and you can sell those at a loss to offset the capital gain in your Apple stock, right? And there you're not going to have any capital gain or very little of it that could impact this net investment income tax. So here's some tax planning tips. Again, you always want to be thinking about this year round. You don't want to be thinking about this come November, December, right? You always want to be on top of this. So next, I'm going to go through a tax return. I'm going to show you a couple of examples. So hopefully you get your arms around this 3.8% tax. All right, so here is a tax return, okay? And this is a married file joint taxpayer, right? And I'm going to walk through this net investment income tax, okay? So as I stated earlier, the threshold of the AGI, adjusted gross income, for a married file joint's $250,000. So I'm going to use that in this example. So you can see here their wages, $240,000. They have dividend income of $9,000. You see this line here, you got total income, and you see here adjusted gross income, AGI. So this is the 2022 tax return, line number 11. So if you're kind of following along here, pull up your 2022 tax return and you want to look at what that number is, okay? Now, and you can see here it's 246, right? And you just stop there, okay? Because you got all this other income, some adjustments to it, but not much. You get to your adjusted gross income. Then you get to page 2 here, other taxes. This is where that net investment income tax would show up here, okay? So you look on your 2022 tax return, line 23. Here they got $25, and we can see here that's essentially self-employment tax, okay? So this couple does not have any net investment income tax because even though they had dividend income, their wages plus the dividend income is below the $250,000. Okay, so that's example 1. Example 2, let's add some interest income, because if you remember from the presentation, interest income also attributes to this or triggers that net investment income. Okay, so we're going to say that they're saving a ton of money in the bank. They got a lot of cash there, and they got interest income of 11 grand. So let's go back to our page 1 here of the 1040, right? Wages stays the same. The dividend income stays the same, but now they got some interest income of 11 grand. Now we go down to this total income, right? 257, and adjusted gross income, 257. Remember, the threshold is 250. So they're about $8,000 to be exact, 7,922 over that 250. Okay. And then you got to look at what their income is, and there's dividend income, interest income that's kind of pushing them over, right? Now we go to that line, let's see here, 23 here. Remember, it was $25. Now it has increased by $321. Okay, so let's go to that schedule 2 here. We can see here, net investment income tax, $301. Because, so of that $7,200 that they're over that 250 threshold, that's creating this 3.8% tax. Now, if you go to this form 8960, you can kind of Google this form too, to kind of see what's on there and how this whole tax is being calculated. So we're going to go here. You can see here, the top portion here is all triggering this net investment income tax, right? So these are the types of income that is contributing to it. So they got taxable interest income, right? They got ordinary dividend income, right? So that's right there, $20,000. But then they had some losses, right? Some capital losses that, kind of reduces that total investment income here down to 17,000. Then you kind of look at this calculation, right? The threshold was 250. They were over by 7,922. 3.8% of that is your 301, and that's your tax right there. So you can kind of calculate this yourselves here. But again, you got to be careful on the triggering points here and think of ways on how you can kind of reduce this, right? So anyways, I just wanted to walk through an example so everyone can kind of look at their tax returns and understand this tax, because we're seeing a lot more people get impacted by this. And if you think about it, if you're in the 24% tax bracket, 25% tax bracket, you add another 3.8%, now you're in a whole different tax bracket, right? So it's really important to understand your tax return, understand where the numbers are coming from, Make sure your CPA is explaining all this to you. And here's like another thing about tax planning, right? You got to think ahead, plan ahead, and there's ways to kind of reduce this tax liability. We're mid-year here. There's a lot of time to kind of make some changes. If you have any questions, leave them in the comments below. Thanks for watching.